Well, I'd like to begin with the credit crisis of 2008. This Five Sigma type event caught thousands of hedge funds and millions of investors off guard. The sudden deflationary event sent the dollar into the stratosphere and subdued almost all alternative asset classes. Could you give listeners your summary of what occurred last year?
Well, basically, according to my statistics and observations, the U.S. economy went into recession in October 2007. But it wasn't right away obvious because, as you know, the Fed cut rates very aggressively after September 18, 2007. And the government, not only in the U.S. but elsewhere, has a talent to massage economic statistics. So it wasn't obvious that there was a recession. And as you know, after September 2007, the CRB index, which is a broad-based index of commodities, soared from 320 to a peak in July 2008 of 473, and then after that it collapsed. But to make a long story short, after the summer of 2008, it became obvious even to the greatest Goldilocks crowd proponents that the U.S. would go into recession, and indeed, after September 2008, the global economy just fell off a cliff, and every month since then, until March of this year, had worse news than the previous months. Now, recently, the bad news is getting better. In other words, we have a deceleration in economic activity on the downside. But to speak of a meaningful rebound in economic activity would be wrong. In the meantime, what happened in 2008, as you pointed out, asset markets were weak, with the exception of U.S. government bonds and the U.S. dollar, because in a weak economic environment, imports into the U.S. decline, and so the trade deficit and the current account deficit of the U.S. declines, and that leads to a relative tightening of global liquidity, which is favorable for the U.S. dollar. Now, more recently, the Fed and other central banks have been engaging in this so-called quantitative easing, or in simple words, money printing in big style. And that offsets some of the liquidity contraction of the private sector, and therefore, since March 6, 2009, the S&P in the U.S. has rallied from 666 to, as you know now, 929. And many emerging economies, stock markets, bottomed out actually already in October, November 2008. So we have, again, a flood of money shifting out of cash, because cash doesn't give you any return. That is the purpose of the Fed. They want essentially to encourage people to speculate. They don't want people to earn high returns on cash. They want to penalize the decent people who have deposits and encourage speculators. And so since the October-November period of last year, we have again a flood of money going into emerging markets, going into commodities. The copper price bottomed out at the end of December 2008 and is up 70% since then. And at the same time, what has happened is the dollar has begun to weaken because of this money printing, and bond prices, which have been in a bull market since September 1981, they probably peaked out in December, on December 18th, 2008, when the 30-year Treasury went down in yield to 2.53%. We're now back above 4%. So this year, we had essentially, since March, a huge rally in equities, and since December, we have a bear market in bonds, in government bonds in the U.S. And I think the government bond market in the U.S. will continue to weaken, interrupted from time to time by short-term rallies. The 10 years and the 30 years.
Exactly. I mean, we saw a bloodbath last week for almost 3 weeks, but the long bond has been breaking down from a long trading range there. Plus, the shorter-term treasuries, though, Dr. Faber, they continue to bode well. Do you believe that that's maybe due to the liquidation of the long bond as money flees that speculative category, looking for higher risk, if you will, in stocks?
Yes, exactly. I mean, I think everybody realizes that eventually over the next 30 years, sometimes inflation will be, of course, much higher than 4%. And I'd like to really emphasize one point. In the last quarter of last year and the first quarter of this year, the U.S. economy was contracting at an annual rate of 6%. But people who talk about deflation, they're misinformed. Just look at the insurance premiums that you have to pay this year compared to a year ago. At the educational cost you have to pay this year compared to a year ago. At healthcare expenditures that you have to pay today compared to a year ago. At food compared to a year ago. I don't see any deflation. And if you have that weak an economy and no deflation, then I think that when the economy, whenever that is, will recover, that we will have actually a relatively high inflation rate. I think the deflationists just don't understand anything about economics, because the fact that the flat panel TV price goes down has to do with technological progress and has to do with a new product becoming a commodity, like a calculator in the 1980s was first high-tech and then it becomes a commodity, or a computer or a mobile phone and so forth. But that is not deflation.
As the money supply continues to rise,
explodes.
So I'm sure you would agree, though, Dr. Faber, that during the credit crisis, credit card companies, major lenders, and major banks curtail the credit that they extend to the consumer. Yes,
that is correct. And it's still happening, but at the same time, and that's what the Fed is doing, and the Treasury, the private sector is contracting credit and tightening lending standards. But the government is flooding the system with government bonds through the creation of these huge fiscal deficits and by quantitative easing, in other words, money printing. And I'd just like to highlight the problem that I see going forward. There will be a time when the Federal Reserve should increase interest rates, and I may add that this happened in the period 2004, June 2004, to August 2006, the Fed increased interest rates, but the interest rate increases on the Fed fund rate from 1% to 5.25% were lagging nominal GDP growth and were lagging the rate of inflation as a broad measure of price increases, not core inflation, which excludes energy and food. So during that period of time, interest rates on the upside lagged, and I think that will be in future also the case, because at that time the government debt will have exploded and the deficits will probably not come down very much or maybe even go up, and the Fed will own a lot of government bonds, so they will be very reluctant